The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Earnings season shifts into third gear, and so too does the record stock rally. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. It feels like the calm before the storm, right?
Yeah, absolutely.
All right, and that storm comes midweek. All right, let's get you started on where things stand. We do have the S&P 500 at a record high, so another day, another fresh high for the S&P 500, now above 6,300. We're seeing bonds gaining, especially at the long end. So you see the 10-year yield coming down almost 5 basis points. It's 4.36%. The dollar is losing ground today. The yen is firmer after the prime minister said he would stay on as leader, even after the ruling coalition lost its majority, and the euro gaining somewhat against the dollar as EU and U.S. negotiators continue to deliberate before that August 1st deadline.
Yeah, and you take a look at the broader markets, the equity markets to be specific, and you take a look at the VIX, muted once again, just a hair above its year-to-date low, but here lies the potential right now to stir up volatility with around 110 S&P 500 companies set to report earnings this week. That includes 2 Mag 7 mega caps, Tesla and Alphabet. And while broad market valuations are elevated, the big hub of the S&P is indeed big tech, which analysts say should command higher multiples because of their consistent growth, cash flow, and margins.
What we're seeing is the winners continue to win. The Uber cap companies have the higher margins, are gaining more market share. There is a real secular trade in AI that will continue.
And Morgan Stanley strategists seem to agree, advising investors to stay bullish as earnings momentum grows. Mike Wilson now leaning toward his team's bull case scenario of 7,200 for the S&P by the middle of next year. And that's largely based on positive operating leverage returning. And that's partly because of lower wage costs and further AI adoption. And that might be why the Sell America trade faded as fast as it cropped up. An investor rotation back into the world's largest economy has been afoot for weeks amid that positive earnings revisions that we've been seeing. Wild swings, though, in the FX market and in the foreign bond market, including in Japan, Korea, Brazil, and elsewhere, also casting a more favorable light on the relative stability, Scarlett, of U.S. assets.
All right, and of course that's because the ongoing trade negotiations can throw everything for a loop at any particular time. Bloomberg Economics says that all things being equal, Trump's tariffs are inflationary for the U.S. They increase import costs, which then compress margins. So the amber line here really tracks the advanced economies, including the U.S., and you can see a slight lift in the fourth quarter. For the rest of the world, the tariffs are actually a drag on growth because they force China to seek alternative markets, leading to a disinflationary impact. And you can see a dip lower here in the purple line, which tracks China, and the blue line, which tracks EM excluding China. Romaine?
All right, let's kick things off with Andrew Szczurowski, portfolio manager of strategic income at Morgan Stanley Investment Management. And Andrew, there's been a lot of talk right now about whether you look at this market and you look at the valuations and you get scared, or whether you look at those valuations and you say, sure, why not? There's plenty of upside left.
Yeah, look, I think I'm looking from the bond standpoint, and I think that for an equity investor, one thing you have to keep in mind is that I think the Fed is going to be coming back on the table later this year. They're not there today. We know we have this tariff inflation that's about to kind of start filtering through. That's going to weigh on some companies. But from a bond standpoint, if you look out 12 months, I think what's going to ultimately win the day is a slowing labor market, and the Fed's eventually going to react to that and look through this tariff inflation, but not today.
Well, one reason why I ask that is because when you look at the equity market, there's clearly sort of a tinge of euphoria, this idea that the worst case is behind us. Mm-hmm. When you look at the bond market, you could almost make an argument that maybe there is, at least as much as the bond market ever gets euphoric, a sense of euphoria there too. You're seeing tight spreads in the corporate space. You're seeing basically stasis for the most part in treasury yields. I mean, I know we've oscillated from up and down, but for the most part, we haven't gone anywhere.
Yeah, I mean, look, from the bond standpoint, like you mentioned, you have tight spreads, but you have high base yield. So I think there's some investors out there that are looking at that all-in yield and saying, you know what, if I can get 5.5% in IG corporate, or I can get 7% in high yield bond, that's good enough compared to where we were a couple of years ago, where high yield was yielding 3% once we came out of the pandemic. I think that if you look, there's still some attractive places, but I think that there's very little room for spreads to come in from here when you look, kind of go out the risk spectrum. But I do think that there's still some opportunities out there. You look at high quality agency MBS, we think there's a place where investors can kind of hide there while you wait for spreads to kind of take a hiccup wider from here.
Andrew, how are you positioning for the possibility that Chair Jay Powell will leave before May 2026?
Yeah, I mean, I think, look, the the Fed chair is just one vote on the committee. Obviously, they have some sway over where things eventually go, but they're not. In order for Trump would have to replace the whole governor board. So I think that it's going to matter, and that president's going to matter. But whether Powell leaves in May or he leaves in December, I think has less of an impact. And I think what's eventually going to win the day and going to help Trump and his goal of lowering interest rates is actually a slowing labor market. Not that he wants a slow labor market, but I do think that the economy was coming out of the pandemic, the consumer was working on kind of steroids, essentially. They had pandemic savings, they had high wages. We're not seeing that same wage growth now. Every labor market indicator is kind of slowly weakening. So I think the next Fed chair, whether that's in December or in May of next year, is going to be looking at that labor market. They're also going to be faced with higher inflation than they ultimately wanted, and we know that Powell talked about this, kind of having these two goals kind of working against each other. I think eventually the labor market wins the day.
Eventually, the labor market wins the day. So when does that first resumption of rate cuts begin?
Yeah, to me, the longer the Fed waits, and we know they're not going to cut anytime soon. We know that a cut's not on the table for June or July. But I think if you hadn't had this tariff policy, the Fed would actually be cutting rates right now. So I think the longer they wait, the more they're going to go. And I think the Fed's unfortunately in a state right now where they have to be reactive and not proactive. Typically in past cycles, Fed's, you look back in kind of 2019, the Fed was being reactive. And so being proactive. And so I think that's where they'd like to be. But I think if you look where neutral is, I think neutral may be a little higher than past cycles. But ultimately, we think the terminal rate for this cycle is going to be more like 250 and not the 3.25 the market's pricing in. So we think there's value in the bond market, but it comes from that kind of belly of the curve and in, and not at the long end of the curve. So we think the curve continues to steepen from here. Not that long end rates can't come down, but they're not going to come down as fast as the front end of the curve.
Is there a risk, though, to that steepening trade or that steepening thesis? What is the main risk?
Yeah, I mean, look, there's a couple of risks. One is that it's a very consensus trade, and it's very rare for consensus trades to have above consensus, returns. And so that's the biggest risk. So the other risk is that the Treasury ultimately can decide where to issue Treasury. So if you wanted to issue no 30-year bonds or no 20-year bonds, it's not something Scott Bessent is entertaining at this time. The third risk is actually that you have a operation twist at the Fed that the current Fed chair wouldn't do, but potentially a next Fed chair would do. So those are the three main risks.
But let me ask you, I hope this isn't a hypothetical question, but Bessent has kind of made clear he does probably going to stay on the shorter end of the curve in terms of issuance, the weighted. If you don't see a meaningful increase or even a potential decrease in the long end issuance, how does that complicate that steepening trade if you never get that actual steepening? I
think it's a great question. I think it's one engine that the trade loses. Now, I think another engine that the trade still has going for it is the fact that there's still a ton of supply. Even if they don't increase supply out there, they're going to maintain that supply. And not to mention, I think the biggest factor is that you have more term premium that should be priced into the long end of the curve. If you have a more volatile inflation environment, you have a more volatile administration that should require, basically, if I'm going to go out 30 years, I should get more than 100 basis points over a 5-year. And so that's been as high as 200 basis points. If we go back historically, it looks kind of more attractive in that range to us.
Andrew, what's the one thing you worry about that's not priced in?
Yeah, I mean, look, probably as Romaine was mentioning earlier, the kind of euphoria that's in the bond market and in the credit and risk markets right now is that we've shaken off so much year to date. We've gone kind of tariff on, tariff off, all these things, and the stock market kind of continues to hit new highs. I think there was, for a minute, people were worried about that kind of dollar losing its reserve status, and I was concerned about what happens if this continues to gain momentum. I think it's going to lose, the dollar is going to lose some of its kind of shine, but ultimately, I still think it is still the reserve currency. There's no replacement anytime soon, but any sort of further progress down that path would concern me, and I think that's something that, again, we had that for a minute in April, but it seems like the market's kind of shrugged that off as well.
Is that the asset class to watch for right now, the dollar?
Yeah, I mean, the dollar matters for a number of reasons. One is that it also imports inflation. As the dollar's going down, obviously we have tariffs that are making inflation going to go up, but also we have a weaker dollar. Anything we're importing is also going to ultimately be more expensive as well. So that's something, you go back to tariff 1.0 during Trump's first term, we actually had a strengthening dollar as this was going on. This time we have the reverse effect. So I think it's something to watch for more on the inflation front, because that could kind of work counter to the Fed's goal of eventually cutting rates again and normalizing policy.
Andrew, great stuff. Great to have you. Andrew Szczurowski, portfolio manager of strategic income with Morgan Stanley Investment Management, kicking us off to the close here on this Monday afternoon. When we come back, a sit down with Kyle Bass over at Hayman Capital Management. His thoughts on what's been going on with trade, what's been going on with tariffs, and of course, what's been going on with the dollar.
Yeah, he's had some big trades linked to currencies of late. All right, plus we're going to discuss the future of FICO with CEO Will Lansing and whether the Genius Act and stablecoin access will alter your credit score.
And speaking of the battle for crypto, we're going to discuss some of the potential headwinds in the fintech and payment space. Devin McGranahan going to be joining us, the CEO of Western Union. All that and more coming up in a little bit, right here on The Close. This is Bloomberg.
All eyes are on the C-suite as we get into the heart of earnings season, and pay packages for some CFOs may be on the chopping block after a 2024 windfall as industries brace for the impact of tariffs. Let's bring in our expert on the CFO cohort, and she is Nina Trentmann, senior editor at Bloomberg Editorial. So talk us through what happened with CFO compensation for 2024, because all the proxy filings are coming through. We're getting a clearer picture.
Yeah, it's always, of course, with a bit of time delay that we're getting this CFO data. It always comes in usually sort of 3 to 5, 6 months after the end of the year because companies release this information in their proxy filings. And so to some degree, while it's a super interesting data, we always have a bit of a time lag, unfortunately. So 24, we saw a strong increase over the prior year where pay increases were basically flat. So in 24, we saw 16% increase on average for publicly listed companies in the U.S., averaging about 2.9 million per CFO, up from 2.5 million. But then also there's huge ranges in this. So the interesting thing is in the data set, we also see that there's companies often with 25 million, 40 million, some CFOs with even more than that. So it's just basically a range in the end that we're seeing.
Who's getting more than that? More than 40 million?
Yeah, well, I guess actually I have the list here.
Okay.
So we have Tesla at 179 million.
Of course.
179 million.
Alphabet
for
at nearly
Yeah.
50 million.
Yeah.
And then there's also a fair amount of companies on there where actually I would have thought it's not so high. Like
Yeah.
Workday, for example, DocuSign, Snowflake. They also were up in this bracket of like north of 40 million per
Well,
year.
I mean, what do you think is driving the increase, the percentage increases that we've been seeing over the years?
I would think, and I know it's mostly the value of equity awards and stock options. So base pay, of course, plays a role and bonuses play a role, but the biggest amount of the increase certainly comes from the value of that. And of course, with share prices being up this year again, of course, we could potentially see another strong year of increases. At the same time, as you pointed out, companies are navigating tariffs and navigating a lot of uncertainty. And so I also heard from compensation consultants that they were saying, well, actually, in this environment, companies might want to be a bit more cautious.
Right, conserve their cash because you never know what's going to happen. How do the CFO compensation plans in the U.S. compare to those outside the U.S.?
Yeah, that's also an interesting one. Maybe not surprising to anyone who works in the U.S., but they're significantly higher here in the U.S. So in Europe, I think the amounts are sort of 30 to 40% lower. In Australia, about half of what people make in the U.S. So I guess if you want to be a CFO and you want to make a lot of money, then you work here in the U.S.
American exceptionalism, Nina.
Appetite to take risks, I think, actually more.
Well, absolutely. But I think the last couple times we've had you on this program, we've talked a lot also about the amount of turnover we're seeing in this role. Because, I mean, with that greater compensation, it's not just, they're getting all this money just for no reason. I mean, there's a lot extra responsibility and a lot of extra hassle given our current situation that the world economy is in. Yeah,
that's true.
Yeah.
And of course, that's to some degree leading to more CFOs being shown the way to the door. Others are also, of course, seeing this as an opportunity because if there's moves, then also people can make opportunistic moves. Actually, the compensation consultants were also saying that the turnover in the market is maybe also a reason for why compensation could actually just remain flat or still increase from last year, because if it's a competitive market and you are a big name CFO, you don't want to change unless the compensation is good. So maybe those two forces might keep each other at bay. We will see.
All right, always great insights. Nina Trentmann, who helps to lead our coverage with the CFO Briefing newsletter. You can subscribe to that on the Bloomberg terminal or on Bloomberg.com. All right, we'll be back in a moment here. When we come back, we're going to set you up for earnings from the Mag 7, a preview of what to expect from the first two of those mega cap tech brethren to come out of the gate this week. That's Tesla and Alphabet. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. It's time now for our top calls, the big movers on the back of analyst recommendations. And we start off today with Pinterest. Morgan Stanley upgrading the social media company to overweight, also lifting the price target to $45 from $37. The analyst says he sees improving macroeconomic trends and that the company's valuation, at least for right now, is, quote, attractive. Those shares rallying about 3% on the day, back to its highest level since late February. Up next, let's take a look at Target. Barclays downgrading the retailer to underweight while maintaining the price target of $91. The analyst sees value in the Target model, but believes sales will continue to underperform without a bigger strategic shift from the company. Those shares down for a second day, down about 1%. And finally, Texas Instruments, Seyffart Global raising the chip maker to neutral from sell. This is ahead of Texas Instruments' earnings report, which is scheduled to be released tomorrow after the bell. Now, the analyst there says that at least for right now, it does appear that conditions won't deteriorate and says that inventories may actually start to improve. Those shares, though, sliding just a touch here on the day, down about 0.6%. And those are some of our top calls. Now, Texas Instruments could be the palate cleanser for this earnings season as we start to shift into the, well, tech side of the earnings calendar. The Mag 7 earnings kicking off this week with two big ones, Tesla and Alphabet, both on Wednesday. Joining us now to discuss is Mandeep Singh, who helps to lead our technology coverage over at Bloomberg Intelligence. All right, Mandeep, let's start off with Alphabet. This is one. Typically not a whole lot of fireworks here, but given all of the spend that we've been seeing in AI, given all of the changes we've been seeing in the ad space when it comes to YouTube and everything else, what are we really expecting? And more importantly, what are investors really expecting to hear out of the company?
I mean, with Alphabet, really, the ad query volume, that is the one that is getting hit by ChatGPT, really adding a lot of users. And on top of that, the engagement, when you look at average time spent on ChatGPT, it's close to 30 minutes now. And that's all searches. So query volume will shrink for Google. And the question is, can they make it up with ad pricing? They did that in the last quarter. Can they do it again? Ad pricing actually grew high single digits. So expectations are higher.
Yeah.
And that's the key metric.
But I am curious about the ad spending. I mean, I don't want to sort of look them in the eye because I know they've been basically an ad juggernaut for years, and a lot of people have sort of called for their demise in the past. But why am I to believe that they can maintain that dominance in the face of everyone seemingly these days using chatbots and basically things that aren't Google search?
I mean, Google has their own chatbot in Gemini, and they are bundling that with all the other things they offer you in terms of consumer using YouTube, and then they have cloud storage. So Google has created that attractive bundle that even if their LLM isn't comparable to ChatGPT, it's still good enough for you to take that bundle as opposed to paying a separate subscription fee for ChatGPT. So from that perspective, they're doing everything, but the LLM kind of field is still dominated by 3-4 players, and I find ChatGPT reasoning model to be still better. When you give people the option to use ChatGPT versus other LLMs, they still go for ChatGPT because the answers are better, the reasoning logic is better. So from that perspective, it's not commoditizing yet. Whereas everyone is thinking if you keep throwing more compute, they will eventually converge in terms of the reasoning logic and the algorithm. That hasn't happened yet because ChatGPT is still, I would say, months ahead.
I look at the best performers and worst performers among the Mag 7 this year, and Tesla and Alphabet are near the bottom. Alphabet's basically little change. Tesla's has lost about 18%. So the focus will really be on their autonomous vehicles, the self-driving offerings. And we know that that's going to be a question mark for Alphabet as well. It's not a key part of its business, but it's there.
It is there, and look, Waymo isn't going to generate any free cash flow for Alphabet. So for a company of Alphabet size, you need that search business to be intact because that's what's subsidizing everything else. That being said, you know, Waymo, right now we have an install base of 1,500 vehicles. They are at a very attractive, run rate of 13 million miles annually. And if they keep adding more vehicles, so the problem for Waymo is how do you scale the technology? Because the cost differential between a Tesla vehicle versus a Waymo vehicle is almost 3 times. Waymo is 3 times more expensive than a Tesla. So if you really have to scale this across cities, you need that hardware cost to come down, and they have to work with OEMs. I don't think Alphabet is getting into car manufacturing anytime soon, so they have to work it out with OEMs and somehow bring that cost down.
Yeah, I don't think they want to get into that anytime soon either. So Tesla, of course, already involved in that business, and its valuation is predicated entirely on what it does with its robotaxi rather than its deliveries of actual electric vehicles.
Yeah, but in the case of Tesla, they don't have the actual level 4 or 5 autonomous miles. You still need someone in the vehicle. So they need to convince the regulators that they have the technology that's comparable to Waymo's in terms of self-driving. And you can't do that just by making claims. You have to have the vehicle drive on the road. So from that perspective, their problem is more software-oriented. Waymo is more bringing down the hardware costs.
I do want to just push a little bit further into earnings season. I know we still have to wait another week or two to get some of the other Mag 7 and big tech names, but I want to ask you specifically about Microsoft, particularly in light of the news that we learned earlier overnight about the hack. When we talk about the rollout of all these AI tools and all these other things that sort of getting plugged in, there's been a lot of talk about whether this is creating some vulnerabilities in a lot of these software and software platforms. And I'm curious as to how you view this hack, whether it's something that's easily resolvable by Microsoft, not just on the technical side, but also in terms of just the perception that consumers and users will have.
I mean, the good thing is this is related to their on-prem products. They've been telling all of their customers to move to cloud. So from that perspective, this kind of gives them another reason to migrate their customers to cloud, because all these vulnerabilities, they start off with on-prem systems that haven't been patched for years, and they have some vulnerabilities. So I feel it makes for a compelling argument to upgrade to cloud. And look, cloud is where you are deploying all your AI.
Yeah.
So from that perspective, I think Microsoft does have a good...
But isn't the counter argument that, like, particularly with AI and the data that goes into it, that some of that data is sensitive enough where you don't necessarily want Microsoft or any company for that matter being the shepherd of it?
No, you're right.
Yeah.
I mean, some of the data will still be on-prem. But with that being said, you really need to kind of keep it at the database level as opposed to maintaining full-fledged systems.
Gotcha.
And I just feel the footprint will shrink over time because companies just don't have the firepower to, have dedicated security teams kind of managing the databases, et cetera.
All right, good stuff. Mandeep Singh, thank you so much. Mandeep Singh of Bloomberg Intelligence giving us an outlook here in terms of what to expect from the Mag 7 when two of them begin reporting this week. And Romain, in terms of the Mag 7, who's the best performer since April 8th?
Since April 8th, I would say Microsoft maybe?
NVIDIA, 78% gain since April 8th. Microsoft, number 3 at 44%.
Who's number 2?
Number 2 is Tesla.
Oh,
but
okay.
I mean, coming from a low base.
Yeah, that makes sense. All
right, coming up, we're going to speak to Kyle Bass, founder and chief investment officer at Hayman Capital Management, where he sees opportunities in emerging currencies and how tariffs are impacting the markets. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. We're taking a look at market action, and yeah, the stock market is higher, but it's been higher for a while. The real action, I feel like, is in the currency market this week, and certainly today.
Yeah, you saw that, of course, really unfold over the last few days and weeks with the yen. And then coming into this morning, over the weekend, it was kind of interesting. I was taking a look at the Hong Kong dollar, which is probably like one of the most successful currency pegs that we've had, at least in the modern era. And it does seem to be maybe potentially cracking a little bit. I mean, we've seen weakness in that space, and there's been a lot of speculation as to exactly why, and more importantly, who's driving it, whether this is something coming directly from the government or whether this is truly foreign investors really starting to push back on their belief about what they think could maybe be unfolding in China and Hong Kong.
Yeah, either way, the Hong Kong Monetary Authority has had to spend a lot of money intervening to support the currency to keep it trading within that narrow band versus the U.S. dollar. So wild moves for the Hong Kong dollar, but certainly within this narrow band.
Yeah, within this narrow band.
All right, let's talk a little bit more about currencies in Asia with Kyle Bass. He is founder and chief investment officer of Hayman Capital Management. Kyle, I want to get to Hong Kong in a moment, but first, I mentioned how the dollar is very active, especially against the yen, and I want to get your sense on the drama in Japanese markets as well, because the yen is stronger. We had a rout in Japanese JGB yields in the last couple of weeks that sent yields to the highest since about 2008. We also had JGB auctions that didn't do that well, and now there's political uncertainty going forward. What's your take on Japanese markets, the bond and the yen?
Yeah, I think it's important to note that look, the Japanese rates are still pegged out to 10 years, and they've decided, the BOJ is elected to let the 30-year, I guess, freely trade, even though it doesn't trade every single day. Japanese sovereign debt to GDP is north of 260%. It's kind of the world's most interesting debt laboratory. And so when you get a scenario like you had with COVID, where you have to remember the whole world is priced in dollars. And so when the US Fed and the US administration decides to print and spend as much as we did, remember we put 40% more M2 into the system between 2020 and 2023. And what did we get? We got about a 40 or 50% inflation of almost everything. And I'll caveat that there are a few things that didn't move 40 or 50% higher in expense. But let's say dwellings and consumer goods and things that people have to buy every day or pay for rent did. So what happened in Japan is the yen went from roughly 100 to 160. And now it's sitting around, what, 145, 147. So when you think about the yen is just moving in the amount of purchasing power it has in dollars. It's really that simple. And so they're in a really bad situation from a debt perspective. They've got a population decline. They are a very important trading partner of the United States and one of the stalwarts of ours in Asia. So I think we're going to do all we can to trade and help the Japanese going forward. But I think they're in a precarious position, i.e., they either have to let their currency go or their bond market go, and they'll never let their bond market go. So I would beware of the yen into the future.
All right, well, we'll keep an eye on that one. I mentioned the Hong Kong dollar. You've bet against the Hong Kong dollar in the past, which of course is pegged to the U.S. currency. And it has experienced some swings because of President Trump's tariffs and the impact there. The HKMA intervening, spending a lot of money to support that currency peg. As Romain was saying, every so often people wonder whether it's time for the Hong Kong dollar to be repegged to a basket of currencies or repegged maybe to the Chinese currency. Are we at one of those times right now?
Yeah, I think, again, when you think about this peg, it's been around since 1983. Back then, the reason the peg was put into place is there was a massive run on the Hong Kong dollar. If you remember, there were rumors back in 1981, 82 about the British handing Hong Kong back to the Chinese. And when those rumors got out, money started fleeing Hong Kong and Asia kind of writ large. And so the Hong Kong dollar depreciated 50% versus the dollar in a basket of world currencies. And we, the United States and the United States dollar, provides the stability to Hong Kong and therefore China in their currency regime. So when you think about that peg, it used to be that as Hong Kong's economy went, so did those of the United States and the West. Now Hong Kong's economy is more inextricably linked with China's, and there's a divergence in economic activity. China has had its worst financial crisis in maybe its modern day history in the last 2 or 3 years. Its 10-year bonds at 1.5%. Its overnight rates are roughly 1.5%. So China's having a really difficult economic period internally. And so those economies no longer move with the same synchronicity that was required. So look at Hong Kong's overnight rates today. The overnight rate is still close to zero. U.S. overnight rates are 4.3. One-year rates in Hong Kong are not around 1%. Ours are still around 4%. And if you can interchangeably own the HKD or USD, you'd be crazy not to convert it to USDs, right? You may earn 3 to 4% more. That's why you're seeing the weakness in the Hong Kong dollar. The question is, can Hong Kong afford to move its rates higher? Because the majority of Hong Kong mortgages are floating rate mortgages tied to short rates. So Hong Kong's in a really bad position right now, and also the geopolitical risks are there.
Well, I'm curious about the geopolitical side as it relates to the economics, because, I mean, Hong Kong and China being more wedded or more in sync, I would think that would almost blunt the positive impact that Hong Kong has had on mainland China and really just the region overall. I mean, we just had a couple of reports last week of executives at Wells Fargo, apparently a patent and trademark employee from the U.S. being detained over there. And then when you look at the interplay between those two economies, what is the potential upside with continuing to do business there?
Yeah, I mean, I think Romain, over the last, call it 5-6 years, maybe longer, I've said that at some point in time, the hard decoupling is certainly coming. We don't share anything in common from a values perspective with the Chinese Communist Party, and that ends up interlacing itself into trade and our relationship, our bilateral relationship. So when China took over Hong Kong post-COVID without a shot fired, and call it corrupted the judiciary and decided to break the Sino-British Joint Declaration and the U.S. Declaration of our relationships with Hong Kong, I don't understand why the West continues to do business with Hong Kong and or China. And I think those that continue to do so will pay a hefty price in the coming years.
Well, what about all the big U.S. companies that, of course, want to do business in China, certainly mainland China, because of the population and obviously the perception of a rising middle class and a rising wealth class? I mean, just last week, we spent countless hours on this network talking about the deal that Jensen Huang struck to be able to sell some of his NVIDIA chips over there in China.
Yeah, look, I think that the NVIDIA deal was basically a hostage exchange. The U.S. desperately needed rare earth magnets, and China desperately needs NVIDIA's H2O chips. And I think we agreed to execute a hostage transfer, i.e. give them the chips, they give us the magnets. But the interesting thing in that transaction is they're requiring us, or U.S. companies, to enter a licensing agreement with the Chinese rare earth magnet suppliers. And we have to disclose very sensitive data to them, how many units of production we have, what the cost per unit is of each car. Ford is basically having to sell its soul to get those magnets. And we're just letting those chips move freely into the Chinese Communist Party's People's Liberation Army. And they're being used to develop AI in the battlefield, AI in their weaponry, AI to develop things to point back at us. So I think that was a deal with the devil that I think we'll end up regretting.
Well, I am curious, though, but from an investment standpoint, Kyle, do you find yourself looking for places to put your money that would maybe counter what you just laid out with regards to China?
Yeah, I think that, we happen to have a partnership with the U.S. Defense Department called Rochefort Management Company, where we are looking for advanced defense technology, both on the offensive side and defensive side, in the United States to help the U.S. military and U.S. Defense Department. And there are a number of managers entering into programs like that where, we spend about 2.9% of GDP on defense today. And we all know NATO is trying to catch up to 2%, just gave a 5% target. When you look historically at periods of war, whether you're talking about the Cold War, the Vietnam War, the Korean War, and or World War II, in World War II, there was one year, 1945, where we spent more than 40% of our GDP on defense. So I think you're going to see the wind in the sails of defense and defense tech for the next decade or more. You saw it in the big, beautiful bill. There's another $200 billion going into shoring up, let's say, where our holes are and where we need to advance. So I think you're going to see defense spending as a percentage of GDP move higher. And I think the money to be invested is on the front end of defense and defense tech in the United States for the next decade.
All right, Kyle. Unfortunately, we have to leave it there. Always great insights. Kyle Bass, founder, Chief Investment Officer at Hayman Capital Management. We'll be back in a moment. This is Bloomberg. All right, time now for our stock of the hour. Taking a look at shares of Block, ticker XYZ. The shares rallying as the digital payments giant gets ready to replace Hess in the S&P 500 this Wednesday. For more on this, let's bring in James Seyffart over at Bloomberg Intelligence to talk a little bit more about a stock that's been on a tear even before the announcement. And of course, this announcement that it goes into the S&P 500, providing a further lift. And I guess that's because once it's in the S&P 500, I think everybody and their mama's pretty much got to buy it, right?
Yeah, I mean, it's hard to know exactly what the dollar amount is that tracks the S&P 500, right? It's in the many trillions. If you look at S&P's reports as of the end of 2023, they thought the passively managed ETF, so index funds tracking this, were at least 10 trillion. So conservatively speaking, you're looking at 13 to 14 trillion dollars, probably more, just in passively managed S&P 500 index products. Which, if this thing gets in, we're expecting it's like just shy of a $50 billion company. We think it'll have a 0.08% weighting, or 8 basis points, which would be somewhere around $11 billion of buying across all those funds. And those are just the ones that are tracking the S&P 500. If you include other derivations of the S&P 500, whether it's like specific sectors or equal weighted or different things, that smart beta, as we call it, the number can get up to around 20 trillion, we think. So the amount of money that tracks the S&P 500 is insane. And that's why we're seeing such big moves and so much trading today in Block.
Right. I mean, I'm looking at volume right now. It's at about 42 million shares. The average volume at this time is about 6.19 million. I know that this is looking far out, but this is really active investors getting ahead of the passive funds, right?
Yeah, exactly. So basically, the trades will need to be done before market open on the 23rd. So for the most part, these funds are going to be setting up their trades. This is mostly active investors and people just pricing in and get their hands on these shares to then ultimately sell to the amount of dollars that I was just talking about getting into block. A lot of times when we see these things, when these things are added, it's things run up into their addition, and oftentimes will keep running as they're being bought up by these passive products. You got to remember, there's also active managers that track this index,
Yep.
So it's not just the passive products that have to buy this. If you don't have exposure, you don't have exposure.
All right, good
You'll
stuff.
underperform.
James, really appreciate it. James Seyffart of Bloomberg Intelligence. Coming up, we take you to the closing bell with Sinead Colton Grant, CIO at BNY Wealth. This is the close on Bloomberg.
From a bond standpoint, if you look out 12 months, I think what's going to ultimately win the day is a slowing labor market, and the Fed's eventually going to react to that and look through this tariff inflation, but not today.
Andrew Szczurowski over at Morgan Stanley Investment Management, kicking us off to the close just about 50 minutes ago. A mixed bag for markets today, Scarlett. You are seeing some of those big tech names help to lift the NASDAQ slightly on the S&P, but everything else pretty much lagging.
Yeah, of course, we get Alphabet and we get Tesla reporting on Wednesday, so a lot of focus on the Mag 7 before that. But for the most part, can we say complacent? You have the VIX at 16 and change.
Yeah, I mean, this has been the parlor game right now. The idea is that do you have a market that is completely unhedged or just completely not prepared for another shock of some kind? And if you go by the VIX, and for that matter, if you go by a lot of what you're seeing in the options market, you aren't seeing a whole lot of at least broad market hedging, maybe in the single stock space, but certainly not on a broad level.
Not on the overall index. We should note also the U.S. dollar weaker by 0.5%. That's going to be a tailwind for earnings season.
Absolutely there. And also I'm curious, too, about the idea of where rates actually go. There's kind of been this push-pull. We've seen kind of rates go up and then come back down. Nevertheless, that steepening of the curve continues as a lot of people have pretty much just looked at the long duration and said, that ain't happening. At least not with this president and with our new Fed chair.
Yeah, although you do have the long end outperforming the short end today, at least.
Yeah, absolutely. Yeah. All right, let's get right to it as we continue to count you down to those bells. Sinead Colton Grant, Chief Investment Officer at BNY Wealth, joins us here in Studio 2. All right, Sinead, I do want to start off talking about earnings season. I mean, I know it's still relatively early, but so far, so good. I mean, we came in with a relatively low bar. I know a lot of the companies that have reported have beaten so far. We're now getting into the real meat of it, where we start to get a lot of the big cap names and a lot of companies that, at least in the past, have shown resilience in the face of all the issues with regards to the economy and tariffs.
And so let's not forget that when we get to the end of last week, 86% of those companies reporting last week beat. So that's not a small number. But let's take a bigger picture where coming into the publications, you had an expectation that Q2 earnings growth would be about 4.5%, maybe a little bit higher. Today, expectations have moved up almost a full percentage point. And that's, remember, coming on top of an extra strong Q1 earnings season. And so look, there are clearly questions about how are tariffs impacting, where are they impacting? But the fundamental questions remain. You mentioned the big tech names. It's around AI. How are they generating revenue? Where are they spending? And then more broadly, how are other industries and other companies starting to implement it?
Well, this raises a question about the sell-off that we had, because it seemed to be predicated on this idea of what the market thought was going to happen with regards to the feed-through from tariffs. I know that hasn't happened yet, but getting to Scarlett's point about complacency, is the market complacent in your view, given that there does not seem to be a lot of hedging of that risk of tariffs and these other economic policies feeding in, or I should say, taking from the bottom line of these companies?
The key differential here is the fundamentals, right? What's actually happening. You've had a couple of companies where they've specifically focused on there has been an impact in tariffs. You have seen some price increases. But look, I think the market got a little bit ahead of itself. It assumed that back in April, when everything was announced, that the impact would be swift and it would be significant. And then what we're actually seeing is that the eventual impact is much, much less. Now, clearly, there are some big deadlines coming up with August 1, where we're going to learn a lot more. But with everything that we know today, we're expecting that earnings grow by about 9% for the full year. But we're at the point when investors start to focus on 2026. And look, a year from now, we think 6,800 on the S&P is easily doable.
But the path there could get pretty rocky. We have to get through this third quarter, which is notoriously volatile. Which sectors do you want to be in? Do you want to play it safe and still go with the big cap tech names that have, come through time and again?
So I do want to focus on what you mentioned about Q3 because it's also generally the lowest returning quarter historically out of all four. Q4 we tend to ramp up a bit again, but that typically also comes with volatility in part just practically because there isn't as much liquidity in markets. A lot of investors, a lot of market participants are just not in the office. So yes, there is going to be some volatility.
There's going to be some volatility. So does that mean you want to stay with what's worked up until now? Go with the big cap tech names, stick with the financials, which have a cocktail of tailwinds supporting them?
Here's what we like. So we do like financials and we do like the tech names. Look, with tech, it's all about AI, how it's being deployed. Are we continuing to see sufficient spend? With financials, obviously, a steepening yield curve is more supportive for them, but there's a huge tailwind potentially to come from deregulation, right? If you think about the priorities of this administration, they were a little bit reversed from what we had seen in the previous Trump administration, where this time round, we first of all got tariffs, then we got the tax bill, and now the focus shifts to deregulation. And so with slightly lower interest rates, we're expecting 2 cuts by the Fed by the end of the year. That should also put a little bit of a tailwind under M&A again. But the sector that I do want to mention, which is a little bit less loved, is utilities, right? So people tend to think about utilities. They think about sort of relatively dull, constant
dividend plays.
Yeah, constant income generation. But that is where you're really going to see an impact from higher power generation needs. We've seen a lot of announcements of that for over the last 6 to 9 months. And what that means when you translate it back to utilities is rather than that steady dividend being in the 4% region, you're going to see some of them tick up to around 7%. And we think that looks pretty interesting.
Are there any other pockets of the market where you see meaningful income generation or an increase in income generation?
Well, look, I mean, you've got to talk about fixed income because given where we've been for most of the last 10 or 15 years, the yields that you can get right now are significantly higher. And the thing that we need to remember in a more normalized yield environment is the yield that you invest at is going to be the biggest determinant of the return over the entire holding period. And so, if you're a resident in a high tax state and you're buying municipals at, what are relatively attractive yields on an after-tax basis, that's pretty attractive.
You still like financials overall, though?
We do.
Yeah.
We do.
Okay. So encouraging earnings season out of we've still got the big banks and the regionals.
Yes, and remember, they're also very linked to the performance of the overall economy. So we think, given what's going on with the consumer, the labor market, we had some really strong retail sales last week, that's very supportive of overall 1% growth for the economy this year, quite handily. That's going to be another tailwind for financials.
All right, Sinead, I have to leave it there. Always a great conversation. Sinead Colton Grant, Chief Investment Officer at BNY Wealth, counting us down to the closing bell, Scarlett, with just about 2.5 minutes until we get there. Modest gains for the S&P and NASDAQ.
Although we do see the indexes rolling over just a little bit here. We're losing a little bit of momentum as we head into the closing bell.
Yeah, and absolutely. And the big setup here, of course, with those earnings on tap. And as Sinead just talked about, don't forget, in less than 2 weeks' time, that August 1st tariff deadline, full market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to that closing bell with a global simulcast, and it starts right now. Tim Stenovic in the radio booth, Carol Master joining him for the day. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Fractional gains for the S&P and the NASDAQ, guys, today, but not much else going on around the markets.
Yeah, I mean, and I'm back for the week, by the way.
Whole week?
Yeah, the whole week.
We'll see what happens by Friday. All right, I'll believe it when I see it.
I've completed my attestation.
Oh, aha. I like that.
I will be here for the week. I just think what an interesting day, right? For most of the day, we saw a pretty decent rally, and then we've just kind of run out of steam here, and I'm just curious what's bringing everybody down here at the close.
Okay,
Kinda
running
weird.
out of steam maybe tomorrow when we hear from some of the defense names like RTX or Northrop Grumman or Lockheed Martin. Or maybe Coca-Cola might put a little zing in tomorrow's trade, depending on what they say about that. I don't want to call it new Coke, guys.
Yeah. Don't they call it Mexican Coke?
It's old
Mexican
Coke.
Yeah, so they do have
Coke.
Mexican Coke here in the U.S. already. But what are they going to say about sugar-free or adding real sugar back to Coke?
Yeah.
Well,
I've been waiting for that for like 4 days.
My husband loves this.
Well, the cost of doing so mean higher prices for those Coke, the new Coke or the new old Coke. It's a big question.
But it raises the question, too. I mean, we talk about this idea of a lot of the pressure that has been put on these companies by policies coming out of Washington and whether that's actually good for business to actually bend to that, or whether you're talking about Coca-Cola, whether you're talking about some of the home builders. And obviously, of course, with the chip stocks, we get Texas Instruments reporting after the bell on Tuesday. We should also point out we are waiting a couple of earnings tonight after the bell, including from Steel Dynamics as well as NXP, a semiconductor. The Dow Jones Industrial Average looks like it's going to end the day roughly unchanged, about 18 to 19 points lower on the day, a drop of less than 0.1%. The S&P 500 closing at a record high, up about 0.1% on the day. The NASDAQ Composite closing at a record high, up about 0.4% on the day. And your laggards, that is in the small and mid-cap space, mid-caps down 0.6%. The Russell 2000 small caps down 0.4.
All right, just taking a look at the S&P 500, folks. It was kind of an even split, and then earlier in the session we had more names to the upside. But here at the close, 320 names in the S&P 500 losing ground, 182 to the upside, Scarlett, and 1 unchanged.
All right, let's take a look at the IMAP, which shows the 11 sectors of the S&P 500. Only 2 groups moved more than 1%. On the upside, it was communication services led by Verizon, gaining 1.9%. On the downside, energy stocks losing about 1% on the day as oil prices decline. Consumer discretionary and materials also finishing the day with modest gains.
All right, so a fair amount of green there. So let's get to some of the individual gainers. No surprise, I'm going to start with Verizon, ticker VZ. It is the #1 gainer in the S&P 500, up as much as 5.5% intraday, finishing with a gain of about 4%. This is after the company reported second quarter results that beat expectations. They raised their profit outlook, buoyed by wireless price increases and recent tax legislation. Lots of talk about Spectrum as well. And this is despite seeing a net loss of about 51,000 monthly consumer wireless subscribers. Our team here at Bloomberg doing an interview with the CEO, so check it out at Bloomberg.com. But nonetheless, definitely an outperformer. Got to talk about Block, ticker XYZ. This one up as much as 9% intraday, hitting the highest intraday since mid-February. Jack Dorsey's fintech firm set to join the S&P 500. Stock finishing with a gain of more than 7%. Those changes going into the S&P will happen prior to the start of trading on July 23rd. So in just a couple of days here. Evercore ISI, they came out saying they expect increased interest in the name. No surprise, right? Those who do index funds will have to tap into this name, but they also said it will translate into incremental passive and active asset managements tracking it. So you're going to be seeing a lot more interest in it. And just one more, Open Door. I know you guys, I'm assuming, talked about it last week. Up as much as 120% today, finishing the day with a gain of about 42%. That was after quite a surge last week. The hedge fund manager, you guys, I'm sure, talked about it. Their social media endorsement, making it the latest stock to experience what you could call as a speculative retail-driven rally.
So we're back, I guess.
More than 20%, though, of the float is shorted. So, yeah, it's a little crazy.
Okay, that's on the crazy side
stock.
of... It's down still like 95% from those highs back in 2021 or something.
I know. So perspective on that.
Yeah, I mean, triple-digit gains are always something. Hey, on the decliners side, the worst performer in the S&P 500, EQT Corporation, an energy firm. Gas producers and energy-related shares tracked U.S. natural gas futures lower today. We did see that futures were down by the most in more than 3 weeks. Weather forecasts, interestingly enough, for late July shifted a bit cooler. Production continued running high. So we did see these stocks under pressure today. EQT Corp, again, the worst performer on a percentage basis in the S&P 500, down 9.5% today. How about a little Domino's? The company reported results before the bell today, and shares were initially higher. They were up as much as 6.5% earlier in the session, but it did reverse gains. The company reported comp sales growth in the second quarter that topped Wall Street estimates. It turns out the Parmesan stuffed crust pizza attracted new customers. It boosted same-store sales, according to company executives on the call. Have you had this?
I'm sorry, is the Parmesan on top of the crust or is it
It's inside the crust. I thought, when I heard about this, I thought that Pizza Hut was the first company like 3 decades ago to do stuffed crust pizza.
Yeah, Pizza Hut is the OG. But
Okay, right? Didn't they have those ads when we were kids that you like eat the pizza backwards?
Yeah.
Okay.
I'm sorry, I'm a New York snob. I don't eat Pizza Hut or Domino's.
Here, here.
Oh my gosh.
Love you, Scarlett.
Listen to you too.
I mean, come on.
Yeah, I agree, but there are a lot of people who don't live in New York, guys,
Right.
who
You
eat
guys
a lot
just
of this
stand
pizza.
on the street corner, fold that
Artisanal
greasy
pizza,
slice
right?
over and
That's right.
step over the
Wow.
rats and eat your.
That's fine.
Yeah.
I'm fine with that. We'll do that every day and twice on Sunday.
All right, that's Scarlett Fu, ladies and gentlemen. Domino's down 0.8%, reversing those earlier gains. Shares of
What's Little
Lululemon
Caesars doing?
falling today by 2.9%. Watching shares, they've been under pressure this year, down 42% so far this year. Kim Basine, who covers the space, had a great article out last week that everybody should check out. It's about this analyst at Jefferies who's logging the core black leggings, their vital products that are rarely discounted. He says they're piling up at outlet stores.
Ooh.
It's an alarming issue for Lululemon. It shows that erosion in core demand for the brand's clothes is facing a lot of competition from these smaller upstarts that I guess everybody's wearing now.
That's a big change for them.
The
Big
basic
change.
black leggings are on sale, and there's too many of them.
That's what Kim Basine is reporting via
Well,
Jefferies.
it's just so much competition now,
Yeah.
right? I mean, you remember years ago, I mean, Lululemon was untouchable, primarily because if you wanted that aesthetic and that quality, that was pretty much the only place to get it. And now, everyone's in the game right now.
They're not all the same, though. Gotta tell you.
I agree.
Right?
What are you wearing? What are you wearing?
Yeah.
You like aloe? What do you?
I
like?
do have aloe, but I do aloe. But I love my Lululemon. They last forever. I have stuff that's like 10, 15.
I agree.
Right?
Yep.
Yeah. Just saying.
Whatever happened to
Not
aloe
transparent, by the way.
Black? Yeah. Let's take a quick look at yields
thing.
here. We did see, of course, big movements in the yield space on the day, mostly to the downside. Nevertheless, the steepening of that curve continues. And there's been a lot of talk about the moves that we saw today, the idea of whether that might actually be a little bit of a haven bid, the idea that people are bidding back into treasuries, particularly with that April 1st deadline coming up next week for tariffs. And of course, that's the same week as a Fed meeting. So the idea between that, the Fed meeting, and of course, earnings, whether there is a need to maybe protect yourself for potential downside risk.
All right, folks, we have a little bit of a theme here and some stories that caught our attention. Has to do with food and beverages. We're going to start with the food side of that. And the heiress, the billionaire owner of In-N-Out Burger, Lindsay Snyder, apparently, first of all, In-N-Out, so iconic when it comes to California, right? That's where they are.
SoCal too, yep.
Right? Exactly. Well, apparently she's moving with her family to Tennessee, citing that raising a family is not easy and doing business is not easy in California.
The company started construction on a 100,000 square foot office building in Franklin. It's just outside of Nashville. It's expected to complete the construction next year. It'll open its first restaurant in the States then as well. No news yet on whether or not we'll see any In-N-Out burgers here in California. So I guess, Scarlett, you're stuck with Domino's and Pizza Hut.
I'm not a big fan of In-N-Out burgers, but I was looking at the tax rate, and
You cannot please Scarlett.
I know. I don't think they're as tasty as they could be. California's corporate tax rate 8.84%. Tennessee's corporate tax rate a flat 6.5%. So
are you a fan?
But they're not moving the company though.
They're
So I mean, this is just her personal thing that she gave on this evangelical podcast. But they're keeping the company based in California.
Well, there's no income tax in Tennessee, so there you go, state income.
But they are going to open up some In-N-Outs in Tennessee too, and they're not planning to go across the country or anything. But
so eventually they might creep their way towards New York. We'll wait to see if that happens. It's mid-July, late
But are
July.
you going to eat it? I mean, you're a pizza snob. You're probably a New York burger snob.
I am a
too,
burger
right?
snob.
Do you have burgers in New York?
You know who used to do a great burger? You know, used to do a great burger at PJ Clark's, and they would do it with Bernays.
You know what has great burgers? Burger Joint.
What are we
Have you guys ever had Burger Joint?
Bernays on a burger? You haven't lived until you tried
Fancy
that.
hamburger.
Oh my gosh.
All right, you know what's really fancy, Scarlett? Pumpkin spice lattes.
Okay, I'm out of all these conversations.
Hold on,
right
it's
now.
mid to late July. It's way too early to be talking about that.
Apparently that people are they're coming back to the menus in August 26th.
Too early.
August 26th, just in time for what?
Labor Day.
Labor Day,
Okay.
yeah. Back to school. Back to school pumpkin spice latte.
Is it an iced pumpkin spice latte?
in the dog days of August, nothing hits the spot than a hot, steaming pumpkin
It'll be
spice
right next to the
latte.
Halloween decoration.
I bet you could find an iced one.
Yeah, sure.
It's too early. It's too
Or
early.
not.
Aren't you glad we're all back? Okay.
Might as well be Christmas.
All right, that's a wrap. Our cross-platform, we got to run. Cross-platform, radio, TV, YouTube, Bloomberg Originals.
Are you sure you're back? Carol's back. She's back.
I don't know where I am.
She attested she's back.
All right, those guys are continuing on TV. We're going to continue here on radio, and we will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. A conversation up ahead with the CEO of Fair Isaac, Will Lansing. Stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. Stocks closed out the day just about 11 minutes ago with the S&P posting up fractional gains on the day, but 63.05 and change is good enough for another record high. It was largely led by a lot of the stocks that we saw in the communication services sector index, and that includes a big move up by Verizon, but also a big bump that we saw from names like Alphabet and Meta. Yields moving slightly lower here on the day, and a big move lower in natural gas futures. A big bet now right about milder weather, particularly here in the Northeast and in the Midwest. If you flip up the board, you can see how that affected some of the individual names, including the big drop that we saw in the stock of LNG. Cheniere Energy, EQT, all moving lower here on the day on the back of the drop in prices. Also keep an eye on Sarepta Therapeutics, a big decline on the day, only about 5%, and that adds to what has basically been a 92% slide in this stock over the last 13 months. The latest drama coming from an FDA request that the company, at least for right now, says it is not going to abide by. A couple of deaths in one of the trials that it has been conducting, something that it has to sort out, but several analysts coming out and saying that there is real risk that this stock could fall further, and at least one analyst saying it could go down to zero. MicroStrategy getting a modest bid on the day, and so too is Open Door Technologies, a 42% jump in the stock on the day, and that actually brings us to our top story. Whether this market is maybe a little bit too euphoric, too lopsided toward upside gains and ignoring some of the downside risks. Critics of the rally point to the grind higher over the past 3 weeks in the S&P that has been devoid of any moves of 1% or more intraday. Critics will also point to the rock bottom levels for the VIX Volatility Index, and others point to the bubbling up of new meme stocks like Open Door. Now, it's no secret that investors want returns. Big returns. They're getting that from Open Door. And the holy grail lately has been the so-called 100 bagger, a reference to stocks that have climbed at least 10,000%. It's an evolution of Peter Lynch's famed quote about 10 baggers. 10 baggers are way more commonplace. 100 baggers, of course, way more rare. Of the current stocks in the S&P 500, only 18 can stake a claim to that milestone. Some for good fundamental reasons, like Nvidia, like Apple, like Tesla. And then you have others, like Monster Beverage, like Tractor Supply, and Fair Isaac. Now, that last name has been in the news a lot lately. Since going public in the late 1980s, the stock has returned, on average, an annual equivalent of 23%, and that includes a more than 10,000% gain since the start of the year 2000. However, the shares did peak in November, and as of lately, they have tumbled into correction as the company's multi-decade dominance over providing credit scoring for would-be homebuyers faces new regulations from the U.S. government-sponsored financing companies Fannie Mae and Freddie Mac, which for the first time are going to start using a competing credit scoring company. Joining us right now to talk about this is the CEO, Will Lansing, who heads FICO. Will, thanks for being here on the program. Look, you guys have basically had this market all to yourselves. There's been a lot of talk about the idea that Fannie and Freddie, which account for at least half the mortgages in the United States, can now have the option of using Vantage Score. I am curious as to how you're preparing for the potential that some of these, that some of the mortgages being originated may now start relying on one of your main competitors.
Well, we'll see how it all shakes out. The reason that we've had the performance we've had, and the reason that FICO scores are thought of the way they are as an industry standard, is that we've been delivering really highly predictive results for a very long time. And there's tremendous efficiencies in using a score like FICO through the system. We'll see how this latest idea with lender choice plays out. There are a lot of policy issues that go with it. And so, I'm confident that Director Pulte at the FHFA is going to wind up studying it and getting industry input and figuring out the pros and cons. I think there's some real challenges, race to the bottom kinds of challenges with lender choice.
With regards to the lender choice, and we should just make it clear to our viewers, they do have the choice. This isn't being mandated that they somehow go to Vantage Score over FICO. You guys were dominant for a reason, is because, at least in the perception of lenders, you offered probably one of the more accurate pictures of the creditworthiness of borrowers. What is your selling point when you stack up your algorithms and your models versus the algorithms and models that VantageScore uses?
Okay, great question. So the FICO 10T is the most predictive score in the marketplace. It's currently being used in the non-conforming market in mortgage. We've done 300 billion in originations with FICO 10T. The process that the FHFA used with Fannie and Freddie evaluating scores over a period of years and figuring out what was most predictive and what had the most benefit for the system, cost of the system, resulted in a recommendation to use FICO 10T along with Vantage. The most recent pronouncement from the FHFA is that Vantage and FICO Classic will be used. And although FICO 10T is still approved, right now the lender choice is FICO Classic and Vantage. FICO Classic and Vantage perform roughly the same. FICO 10T significantly outperforms Vantage, which means you're going to have lower credit defaults and probably qualify, well, not probably, our analysis says we'll qualify 5% more borrowers.
Is there a concern that, and this was raised a few years ago when VantageScore really kind of came to fruition, the idea that they were putting inputs in there that I guess traditional lenders in the past may have looked past, whether it was, your rent history, other types of payment history that might not have had a direct relevance on your ability to actually pay a mortgage. And I am curious if you have any worries about the credit quality of people who would be approved and whether that raises any sort of extra default risk.
Well, I definitely have concerns about it, but not because of including alternative information like rent. Rental data is useful. FICO 10T uses it just like Vantage does. The issue there is there's just not a lot of rental data because the landlords don't report it. In general, landlords don't report it, so it's not really part of the credit file. There's a little bit there, but not a lot. The issue is that Vantage has much looser, more lax credit standards. Their standards for scoring, for example, they'll score on 1 month of data. We need 6 months minimum because we think you can't draw a line with one data point. The challenge is if you have two score system and people can choose between the two scores and they don't hold the risk because the risk gets passed to Fannie and Freddie and ultimately to the U.S. taxpayer. The risk is you'll have a race to the bottom. You'll have people shopping for the most lax score. You'll wind up with more of those lax scores. You'll have more credit defaults. And frankly, one of the toughest challenges is you'll wind up with higher capital requirements from the regulators. And that winds up translating into higher rates and fewer mortgages, frankly. So, there's a lot of challenges with it.
So I'm wondering if you could just kind of also just address investors for a second too, Will, because there is concern that with the competition, of course, that might mean that might constrain some of your pricing power. And you've had pretty aggressive pricing power over the years. Is there any sense here that you might have to temper that and temper future increases?
I think there's a lot of misconceptions about our pricing. The FICO score is an incredible value. We charge, for the mortgage score, we charge $4.95 out of about $6,000 in closing costs. So the whole idea that the FICO score is somehow a costly element in the mortgage industry is kind of crazy. We have enjoyed the fact that the score is an industry standard, it's widely used, and frankly, most of the places where the FICO score is used, there's no government mandate, there's no FHFA. It's done with the free market and a lot of choice on the part of the people who choose to buy it. And so I imagine that will remain unchanged. We have a tremendous value. We are closing a value gap and raising prices over time. But it's important for us to not shock the system and for us to do it in a predictable way. And so we do that. But I'm not concerned about the future because I think that we represent tremendous value.
But $4.95 obviously is not a lot, but there are a lot of people, your critics, who looked at the increases over the years. The idea that you went from basically sub $1, 2018, 2019 to almost $5 today.
Look, the difference between a penny and 5 cents is 500%. It sounds terrible in percentage terms, but let's face it, we're talking about the price of the FICO score being in the neighborhood of a cup of coffee. And we're talking about $6,000 of closing costs, hundreds of dollars in other fees, hundreds of dollars in title insurance fees, for example. So $4.95, frankly, I think it's a bargain. We could give it away for free and it wouldn't change anyone's costs.
Have you had direct discussions either with Bill Pulte at FHFA or anyone else in the administration?
Yes, of course. Of course we have.
So what's their beef with you?
Well, look, I think that the director is, he's a man of action. He wants to move quickly. He's decision oriented. And frankly, this whole process has taken years. It's true that it's taken years to get to this point. And so it's not surprising to me at all that he's working towards getting to a solution as quickly as he can. What's on the table right now is what's called an interim implementation. Mm-hmm. And it's a little puzzling to us why FICO 10T is not in the interim implementation, since it's the most predictive score. It's the score that both Fannie and Freddie evaluated and recognized as the most predictive score. So, frankly, I hope that they will release this data to the public. We have a white paper that explains it on our website, but it'd be great coming from Fannie and Freddie. So I'd love for them to release that. That's kind of where we sit today.
Yeah. So, well, just one quick final question. And I'm just curious as to what you're seeing just overall right now in the mortgage market, irrespective of what's coming out of, the government itself. Are things picking back up? I know we had some issues given how high mortgage rates got. Are things picking back up?
I haven't really seen a lot of pickup. A little pickup, yes. A lot, no. Rates are still relatively high. But it doesn't take very much of a drop in rates to drive a lot of refi and buyers and sellers getting closer together. So, we're all optimistic.
All right. Well, I really appreciate you taking time for us. Will Lansing.
Thank you.
Will Lansing, the CEO of FICO. Now, when we come back, we're going to actually stay in this space and just broaden it out a little bit into payments, into crypto, into stablecoins. We're going to talk to the head of Western Union, ringing the closing bell at the New York Stock Exchange today, but still some concerns here about some of those policies out of Washington. This is The Close on Bloomberg. All right, President Trump's newly minted stablecoin regulation law may create headwinds for some financial services companies. That could even include our next guest, who says obstacles may be emerging from the U.S. embracing crypto. Joining us right now from the floor of the New York Stock Exchange, where he just got done ringing the closing bell, is Devin McGranahan. He's the CEO of Western Union. Devin, great to have you here on the program. It's always amazing, a company like yours that has basically stood the test of time for decades, really, I guess, probably over a century at this point. And it's had to evolve over those years and over those decades. And now you're kind of looking down the face of, I guess, a crypto world. And I am curious as to how, if at all, that affects you.
I mean, it's great to be here. Thank you for having us. Indeed, we're 175 years old, and we've been innovating across that 175 years. And stablecoins is just yet one more opportunity to innovate. There are three real opportunities for us. Anytime you can move money faster across borders is going to be good for Western Union and good for Western Union's customers. Second, last I checked, you couldn't spend stablecoin if you wanted to buy a Coca-Cola. So converting stablecoin into fiat currencies, particularly in harder to convert currencies around the world, is an opportunity for us. And then for many of our customers around the world, a stablecoin presents a store of value that's tough to achieve in their country. So offering stablecoin as a store of value to our customers is going to be an opportunity. We see stablecoin really as an opportunity, not as a threat.
What's the rollout looking like for Western Union on that front?
Well, we're already innovating in several places in the world on moving money and settling. So both in South America and in Africa, we are innovating our settlement processes to move money quicker and to more easily convert into local currency in partnerships with some of the infrastructure companies you've had on this show. So we are also exploring other partnerships with people who want on-ramps and off-ramps in different parts of the world on how we could enable Western Union's funds in and funds out to enable people to purchase and sell stablecoins. Finally, we're investigating how we might offer stablecoin products in our digital wallets to our customers around the world, again, in partnerships with many of the companies that you've talked to over the course of the last couple of weeks.
What's the balance between this push into that space, and not just with regards to crypto, but overall the more digital strategy that I know you and your team at Western Union have been working on for some time, the balance between that and what we see in the traditional retail side of the business?
Right, and so we have about $1 billion revenue digital business. It's growing, obviously, at faster rates than our traditional retail business. We also think of our retail business not just as cash. So retail is a value proposition where you can have in-person service. People will fund with bank products, cards, credit cards, debit cards, bank accounts, and particularly with the passage of the big, beautiful bill, more and more people will be funding transactions in retail with bank products. The same is true on the payout side. Our payout to account, payout to digital wallet business around the world is growing north of 30% in almost all geographies. So we see the value proposition more about funding and paying out, regardless of whether the person wants to do it from their app or they want to do it in a retail location.
I'm curious, Devin, as to how business has been going in light of some of the issues, at least here in the United States, with regards to the immigration crackdown, the idea that you had a lot of folks here in the U.S., whether they were here legally or illegally, who would work here, send money back, often using services like Western Union to get that money back to their families. Have you seen a significant decline in that activity?
You said the key words, which is work here and send money back. Most of my customers are employed, have been employed, they've already covered their basic living expenses, and are in fact sending money home to loved ones in communities that they're from. They've been in these communities for many, many years. Many times they own small businesses and they employ other people. We've seen our business slow a bit, but the majority of our customers have been here in the United States for many, many years, are productively part of the economy, and in fact are sending money home. The other thing to remember is our business is 60% outside of the U.S., 40% inside of the U.S., and the dynamics outside of the U.S. have been more positive over the last couple of quarters than they have been inside the U.S.
Is that where future expansion comes? Is that primarily an international story for Western Union?
Sure. The Middle East is a big expansion for us. As you know, lots and lots of investment happening in the Middle East. Many people coming into those countries to help build out infrastructure. Asia is a big expansion for us, as well as Africa. Our European business has been particularly strong the last couple of quarters, and so we see opportunities outside of the Americas as powering the company for the next couple of quarters.
Hey, Devin, really appreciate you taking time for us, and particularly on a very busy day for you. Devin McGranahan, he's the CEO over at Western Union, live from the floor of the New York Stock Exchange. Meanwhile, we do want to check back in on the earnings season, getting results out of NXP Semiconductors, down about 5% in the after-hours trade. A miss on the bottom line, $1.75 for EPS in the most recent quarter, though we should point out revenue also did fall in the period, down about 6% to about $2.93 billion. Believe it or not, though, that was still ahead of estimates. The guidance for the full year, the guidance for the third quarter, the company says look for about $3.05 to $3.25 billion. The low end of that range is below the average of analyst estimates. The company also says it sees adjusted EPS of $2.89 to $3.30 a share for the current quarter. All right. Well, speaking of earnings, a lot of traders are out there looking at corporate fundamentals and looking at other things for any signs of resilience against the backdrop of uncertainty about the economy, uncertainty about tariffs. JPMorgan Asset Management releasing their mid-year outlook warning policy has gone from an acute to a chronic issue for markets. It's no longer in the driver's seat, but still matters for idiosyncratic earnings impact. Joining us right now is Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. Gabriela, great to see you.
Great to see you, Romain.
All right, so what does that mean? I mean, we talk about, I look at the market and I look at investor sentiment, and there's been a lot of this talk that people are too complacent. Nobody's really looking at the risk out there. What are you seeing?
So I think policy is no longer the day-to-day driver like it was April, May, when we were getting on an absolute basis 4 or 5 percentage point moves in equity markets, just on any kind of headline around, especially tariff policy. So I think we're in a phase much more where the day-to-day is back to being driven by earnings results, back to being driven by the AI theme. But it's really beneath the surface that we do still expect to see the impact of policy changes, including in earnings for certain companies, especially your more retail-oriented, even just more broadly consumer-oriented companies that derive a higher share of revenue, a higher share of suppliers from overseas, and where there's some questions around pricing power.
Do you have any sense of sort of what that impact could be? Because everyone has started to price that in. They price in the worst case scenarios, as you know, and now they price that all out because so far we haven't really seen it materially. That doesn't mean it's not coming. I guess the question is, when it does arrive, is it going to be something these companies can manage, or is it going to be so material that we are going to see a revaluation on some of these stocks?
It's been interesting. And in April, if you take the Mag 7 aside and you just look at 493 earnings expectations, they've been cut in half since April. And I think that was already research analysts overpricing the impacts of tariffs. So far, we've only had 20% of companies report, but they're reporting by a larger than normal share. They're really beating those low expectations. Of course, it's going to be about guidance and what companies say about shifting supply chains and pricing power. So I think that's still to be seen in the second half. It'll especially show up in margins. And I think for the equity market, actually a little bit of CPI inflation is actually necessary as a sign that companies are able to pass, whether it's 50, 60% of those tariff increases onto a final consumer. So we need a little bit of Goldilocks inflation.
That's a good point. I am curious, though, about the potential positive aspects of some of the policies coming. We focus so much on the negative, and there are a lot of negatives. But of course, the president and the White House would point you to the tax and budget bill, and they would say, look, there's effectively stimulus in there. They're not calling it that, but that's effectively what it is. Do you see any potential upside for stocks as a result of some of the provisions in that bill?
So there might be, and I think it's an important offset for the consumer for some of this tariff increase we're seeing and still expect to see, especially in the first half where retroactively households might get a really big tax refund, but it helps offset it. I think it is right not to think about it as stimulus because it's not something to fuel incremental spending. But it is nonetheless something that helps take off a more meaningful slowing of consumer spending off the table. Besides that, for corporations, this idea around immediate expensing, accelerated depreciation, this is something we think companies are going to start announcing a pull forward of CapEx investments, R&D investments as a result of the tax bill. I think elsewhere you can see the impact of policy in things like financials, on deregulation, and also steeper curves because of all this fiscal spending.
We'll talk about the steeper curves. We were talking, my colleagues and I were talking on last week about the latest data on money market instruments and the idea that while they're coming down a little bit, we're still $7 trillion in money market assets. Do you see any sort of meaningful potential for that money to come off the sidelines, if not necessarily out of short-term fixed income and into something riskier like equities? Could it at least maybe go into longer dated fixed income?
And I think we're starting to speak to a lot of investors about that, getting ahead of this resumption of Fed cuts when they do arrive later in the year. We still see a space for about 100 basis point cuts over the next 12 months. That's on the very, very ultra short end. I think what's been interesting is to see a steepening. If you look at the 2s, 10s, the 5s, 30s, those are much, much steeper than they've been since early 2022. And we think that's the general trend to continue, especially because of all this fiscal issuance that's happening on the long end. Plus just uncertainty about inflation.
But just to be clear, so are you modeling in multiple rate cuts right now by the Fed?
I think we feel more conviction in saying 100 basis points or 4 cuts of 25 over the next 12 months.
Okay.
Previously, we thought we could start over the summer, but I think the feed through to actual tariff revenue and then to actual consumer price inflation is happening more gradually than we expected. Still to be seen over the next few months, and so the Fed would prefer to stay in this wait and see mode. In general, for fixed income, our main conclusions are, look, we're settling in at a range here around elevated rates, very low spreads, and so just focus on the all-in yield. Don't wait to time any kind of improvement in credit spreads or lowering of rates. Just go for the all-in yield, really attractive in things like securitized debt, municipal bonds, high yield, so lots to do already.
All right, Gabriela, great stuff. Have to leave it there. Gabriela Santos over at JPMorgan Asset Management with her mid-year outlook. When we come back, we're going to talk crypto with the CEO of Africa's largest stablecoin company. This is The Close on Bloomberg. All right, the total value of the crypto market now sits at about $4 trillion. This is President Donald Trump signs off on the stablecoin regulation known as the Genius Act. The president calling it a massive validation for crypto, with 2 other key bills in the hands of Congress. For more on stablecoins' stronghold in the U.S. and abroad, let's bring in a key stakeholder. His name is Chris Maurice, and is the CEO of a company called Yellow Card, which is Africa's largest licensed stablecoin company. Great to see you, Chris.
Good to be here, sir.
You must be feeling pretty good right now. I mean, 2 years ago, everyone was talking about stablecoins, but you did not necessarily have the wind at your back the way you do now, at least here in the U.S., with an administration that seems supportive.
Yeah, look, I've been telling people, there have been much worse times to be in the space.
Yeah.
So, I've lived through pretty much all of them. It's really been, just a great run for the last, 6-8 months now since the election.
So just for folks who aren't familiar with Yellow Card, the legend goes, and correct me if I'm wrong, you were a student at Auburn University. You basically witnessed somebody trying to sort of transfer money, and you saw how much money they had to pay in order to transfer that money. And you kind of thought to yourself, shouldn't there be an easy way to do this, or a cheaper way?
Yeah, 100%, right?
Yeah.
And and there is now, right? So at the time, that was back in 2017, right? So at the time, it was Bitcoin, and hey, Bitcoin, it's free, it's instant, it's fun, all this great stuff. And the more that we started thinking about it, it's what would this guy's mom do with $200 in Bitcoin?
Yeah.
Right? You can send it around the world, but then how are you actually going to transact with it?
Yeah.
Right? And so, now with stablecoins, there's just a new way of actually being able to interact with the dollar, the world's global reserve currency that we're all using on a daily basis.
It's interesting, too, because, we mentioned that, of course, you're the largest one in Africa, licensed one in Africa right now. And we've seen, particularly in the fintech space, we've seen a lot of the countries in Africa, particularly in the sub-Saharan countries, really sort of embrace fintech in a way that here in the U.S. we were maybe a little bit late, relatively speaking. Was the need there because of the transaction costs? Was it because of transparency? What was the real need?
Yeah, I think when you look broadly across the continent, you're talking about, essentially, what was a blank slate, right, before fintech.
Yeah.
You didn't have as much of, incumbent infrastructure as you did in, the U.S. and Europe and other parts of the world. And so, fintech was able to really take the continent by storm. And now that's transferring over to crypto, right, and to stablecoins specifically. A lot of the, traditional rails, especially for U.S. dollars, just don't work, right?
Yeah.
Look, the intermediary bank system and, SWIFT and these systems were not set up for emerging markets.
Yeah.
They were set up for the U.S., right? They're not a benefit to anybody else in the world. And so, now you have this technology with stablecoins that's just fundamentally changing the way that people interact with the dollar.
Yeah.
It's changing the way that businesses around the world interact with the dollar. And it enables them to be able to move that money outside of the intermediary system, right, without having to ask New York for permission to move that money.
So what happens as we get more players into this space? For the last few years, it's basically been Tether and a couple other companies, at least here in the U.S. side, that have kind of dominated. But when you start hearing traditional banks talking about doing this, we were just interviewing the CEO of Western Union, they're moving into stable coins. Is that a net positive for you, or are you worried about the competition?
No, look, we're working with a lot of these banks and companies to, help power that, right?
Okay.
That's what we do, is provide that underlying infrastructure. And I think, the reality is, especially now with Genius, you are going to see a lot of people moving into the space, especially on the issuance side. And you're already seeing that with banks, right? You have a lot of the large, JPMorgan and BOA and Citi and all these others that have announced some semblance of a plan to issue stablecoins.
How do you sort of deal, though, with the criticism, and I'm talking more so the criticism by governments that are concerned that this could be just ripe for fraud. It would potentially, for some of these countries, maybe undermine their own currency systems in a way. What's your response to that?
Yeah, so I think from a fraud standpoint, the blockchain is much safer than the traditional banking system, right? If I send you $1,000 right now to your bank account, it's a black box. I don't know what you're doing with that money from there. I don't know where you're sending it. With blockchain, I can see every wallet you've ever interacted with. If you're 2 hops away from a North Korean wallet, I can see that on chain.
Okay.
And so it's just a much different how do you say, level of transparency. And then, specifically when it comes to, this idea of undermining local currencies and local economies, that's just not something that we're seeing in practice, right? What this technology is doing and what stablecoins are doing is, like I mentioned, it's fundamentally changing the way that people interact with the dollar and shifting the way that they already interacted with the dollar to make it more efficient. So this isn't undermining local currencies. What I tell people is it'll be a cold day in hell before you walk into a coffee shop in Nairobi and you're paying for your latte with USDT or stable coins, right? That's just not the use case that I subscribe to.
And just real quick, I mean, part of the use case, at least with the yellow card and the way you brokered things over there, was the idea that there were a lot of businesses, like legitimate business, large businesses, that were having trouble transacting, doing business. We've talked a lot on the show about major corporations that have moved out of certain African nations because they couldn't get their hands on the dollars to actually make the trend to buy and sell what they needed here. So that filled a role. But you still have a lot of countries in Africa that either have explicit bans on anything crypto related, and others that maybe not an explicit ban, but certainly implicit.
Yeah, so I mean, look, you're 100% correct, right? You've had, companies like Johnson & Johnson that have had to leave certain African countries because of issues with access to the dollar. And I don't think I need to explain to anybody why Johnson & Johnson leaving, the market is bad for everybody involved. What I would say though, in terms of the regulation, so you only have 4 countries on the continent that have actually banned crypto, and that's all North African countries. So that's Algeria, Morocco, Tunisia, and Egypt. Outside of that, you have, especially in sub-Saharan Africa, you have, what has been, overall a very friendly move, especially over the past 2.5 years in favor of the space. I think they've seen, these countries have seen the benefits that this space has brought in the US and in other developed markets. And, look, they want those benefits to be homegrown. And also they see the adoption, right? I mean, you're talking about, Nigeria is #1 for stablecoin adoption, right? And that's a Visa stat, right? So, I mean, you're seeing this adoption, across the board. And what I like to tell people is before November, Africa was the best place to run a company in crypto in terms of the regulatory openness.
All right, and still is, I take it?
Well, look, it's changed a lot in the U.S.
Yeah, it certainly has. All right, we have to leave it there. Chris, great to have you. Chris Maurice there, the CEO of Yellow Card. We'll be back in a moment. This is Bloomberg. All right, time now to talk about Jay Jenkins. You might know him better as Jeezy, or your favorite rapper's favorite rapper, a multi-platinum and Grammy-nominated artist and entrepreneur. And I had a chance to catch up with him today, just ahead of the 20th anniversary of his seminal album, Let's Get It, Thug Motivation 101, an album that defined trap music and became a cultural touchstone. He talked a lot about what got him from there to here and what's coming up next. Take a listen.
I was basically living from a survival's mindset. I didn't know if I was going to see 06, just under the circumstances. So I was just really putting everything I had in the music just in case, because I didn't know the outcome. There was a lot of things happening around me, very dire consequences, life or death, prison, those things. And the music was my only escape. So I just focused on that in the present moment, but I didn't look past, I didn't see platinum or tours or none of that. I just wanted to be heard.
What was the difference between being an independent artist and a major label artist?
Well, if I had it my way, I would have stayed independent. But again, under my circumstances, like I had to find something legitimate that was going to open the doors for me. And doing mixtapes is something that's it's like an art, right? And it's like an art that you can be as creative as you want because there's no boundaries, there's no no fences or anything. You can be as free as you want, and you're not trying to make this quote unquote radio album, or you're not kind of conforming to the industry. So it's your purest work, if I'm honest. You know what I'm saying?
Yeah.
And the album would be getting the deal was one of those things where I was able to spread my movement and my vision, and I understood that. But the ground roots was the mixtape. That's how I became who I was and got people to understand what I was trying to do by being 100% authentically me.
When you look at the music industry today, I mean, there are so many artists that start independent and to a certain extent stay independent. Do artists need major labels today like they might have needed?
Not today.
Yeah.
This generation has definitely proven that.
Yeah.
don't get me wrong, I love what the label did for me. I wouldn't be sitting here. But at the same time, I think as much as you can control your art and your vision and what seems to be true to you and being authentically yourself, I think you should hold on to that because that's where it gets lost in the sauce. I mean, all money ain't good money.
Yeah. So as we're here on the 20th anniversary on July 26th, you're doing a live symphonic performance tour for this album, a re-release version of this album.
The first of its kind, so I'm actually on a tour right now with the Color of Noise Orchestra to celebrate the 20th anniversary of my first album, which was TM101. And it's been a beautiful thing. And actually on the anniversary, July 26th, I will be in my hometown of Atlanta, Georgia, where it all started at the Fox Theater. It's already sold out. We'll be in Savannah day before that. And actually releasing a version of the symphonic album, TM101, with the Color of Noise Symphony Orchestra, conducted by Derek Hodges, and produced by Adam Blackstone.
I am curious as to the business ventures that you've been involved with, the ones that maybe you're looking to get involved with in the future.
Well, I'm in business, so this is the thing. So music was my talent, but business has always been my passion. Like my mentors are like Magic Johnson. You know, he's great in the game on the court, but he's great. My mentors are like Lionel Richie. You know what I'm saying? He make great music, but he's a great businessman. That's the goal. You know what I'm saying? Art is one part of it, but we thrive and do our best when we put in situations where we can actually think through things. Because you got to think about it. Coming from these street, you know, these street circumstances, you really can run a Fortune 500 company. And that's what you inspire to do. So for me, I align with things that are with my lifestyle. You know, there was a point in time where I was an owner in Avion Tequila before we built it and sold it to Pernod Ricard and different business ventures like that. But, you know, no longer do I drink tequila. So now I'm in the energy drink space, which is Edge. We're launching that next month. It's going to be amazing. We also have a Defiance Fuel, which is water, as an athlete water. Amazing product. I'm really big in entrepreneurship. We got some skincare stuff coming this year as well. So it's like, real estate is what I meant to say. Real estate is my thing. I grew up in a trailer that wasn't bigger than this room, you know, with my mom and my sister. So it was always in my heart to own something, you know, so real estate is a big deal for me.
You buying residential or commercial?
Residential, commercial. I mean, that's my little catchphrase. People know that. I say I own half of Atlanta. I'm working on the other half.
That was the rapper Jeezy talking about his evolution from his first major studio album 20 years ago to today. Meanwhile, we do want to set you up for what to watch over the next 24 hours, and we are going to focus on earnings. Before the bell tomorrow, we get a slew of earnings across the economic spectrum. GM, D.R. Horton, Coca-Cola, Sherwin-Williams, and Lockheed Martin, just to name a few. And after the bell, we get Texas Instruments, Capital One, Chubb, and Intuitive Surgical. Also going to get some Fed speak, and, well, Fed speak from, well, the main person at the Fed. Fed Chair Jay Powell set to give welcome remarks at a conference focused on the regulatory capital framework for large banks. I'm not sure that's what people are going to be listening for, but we'll bring it to you as soon as it happens. Thanks for joining us here on The Close. We'll be back tomorrow right here on Bloomberg.